It's Christmas time, so let's talk about Coca Cola. This brand is so powerful that it has created the modern Santa Claus with its red and white suit. Before that, he was depicted in green, blue, or even brown. But now, every child knows that Santa Claus and Coca Cola always go together. That is a moat. It ensures that this brand is going to be here for generations to come. So let's take a look at this business. Let's analyze it, value it, and decide, does it make sense to invest in it in 2024? First, let's take a look at the current results. Revenue is up by 8% year over year. Net income is up by 9.3%. Cash is up by 24.8% in 9 months. And the debt is down by 6%. Such results are really nice, and not only for a massive and old company, but for almost any company. If you were to invest $1,000 into Coca-Cola 10 years ago, you could buy around 25 shares. And today, they would be worth something close to $1,465. But let's not forget about the dividends. Through the 10 years, you would receive $387 as dividends. So if we add the current value of shares and the dividends, we get $1,852. That is a gain of 85% in 10 years. That's not bad. Individual insiders, that is an X. 0.7% of the company is owned by individual insiders. And we would like to see this number over 2%. But I think it is important to notice that a lot of board members and people from the leadership team own a number of shares. So it is not that bad. I would like them to have more skin in the game, but at least they have some. And are individual insiders buying? That is an X. In the last year, we see only sale transactions. And do super investors own this company? That is a check with 7 super investors, including people like Warren Buffett, Lee Ainsley, or Thomas Russo. And are super investors buying right now? That is a check. In the last quarter, they bought over 35,000 shares and sold just over 1,000 shares. So a very meaningful difference. Return on invested capital. That is a check at 11% 10-year median returns. And we want to see this number higher than 10%, so it just made it. And free cash flow growth. That is an X at 1.8% 10-year compound annual growth rate. And also here, we want to see this number over 10%. So unfortunately, such low growth is a little bit disappointing. But if your product is almost everywhere in the world, it is really hard to grow from that. And what do we know about net profit margin? It is a check at 23.9%, and the industry average is just 14.6%. So it is an outstanding margin. Warren Buffett talked a lot about Coca-Cola's pricing power. They can be substantially more expensive, but still people would not switch to, let's say, Bold Cola. Or would they? And now let's take a look at share buyback. It is a check with 2.5% of shares bought back in the last 10 years. We could expect bigger share buybacks, but if the stock is expensive, then buying your own shares is not really a wise thing. So 2.5% is probably okay. And let's take a look at the debt. It is an X. It would take 3.3 years to pay the long-term debt with a current free cash flow. And I would like to see this number under 2 years, so the debt is a little bit too high. The dividend yield is 3.1%. So in the last 12 months, shareholders got $1.84 per every share through dividends. And the payout ratio? That is an X at 68.7%. And we want to see it somewhere between 20 and 50%. So they are distributing almost 70% of their earnings through dividends. That does not leave a lot for expansion of the company. But as we know, it does not have a lot of growth possibilities. So again, in this case, such a payout ratio may be justified. And what do we know about dividend growth? It is a check at 3.4% annually. And the dividend is growing every year for the last 61 years. So Coca Cola is a dividend king. And that is a pretty exclusive club, so we should not expect the dividends to go down anytime soon. Price to earnings ratio is 23.6, so it is around the current average of S&P 500. But to properly value it, we will use a discounted cash flow formula, and we will create 3 scenarios of the future growth of Coca-Cola. In the low scenario, we will estimate a growth of 4% for the first 5 years and then 3%. In the medium, 6% and then 5%. And in the high scenario, 8% for the first 5 years and then 6% growth. Now, why did I use such estimates? Well, soft drinks market is expected to grow by 4.15% per year till 2027. So the low scenario predicts that Coca-Cola will be close to the market average. Medium scenario predicts that it will do better than the average, and the high scenario predicts that it will grow twice as fast as the market. And with such estimates, the intrinsic value in the low scenario is $28, in the medium scenario $34, and in the high scenario $38. But we haven't finished yet. We also have to apply a margin of safety. I use a 30% one, but you can use any margin that makes you feel comfortable. Just remember that the higher it is, the safer the investment. So with such a margin, we get in the low scenario $20, in the medium $23, and in the high one $27. And the current price is around $58. So it is all in the red. Coca-Cola is rather expensive right now. So it is a company with an incredible pricing power, fantastic brand, loyal customers, and it is also a dividend king. So there is really not a lot to dislike about Coca-Cola. Well, maybe except the slow growth and high price. If you are a dividend investor, then this is definitely something to consider. If you don't mind a slow growth but want to minimize the chance of losing your money, then also this can be an option. But if you are looking for Coca-Cola to go to the moon, I don't think it's very likely, maybe because they are already there. So Merry Christmas, have some quality time with your loved ones, and if you are looking for a gift, maybe even for yourself, then you can get a short and witty ebook called The Way to Wealth, written by Benjamin Franklin, either by buying it on our Patreon page or by becoming a patron and getting the ebook for free. Thank you so much for watching, and see you in the next one.